Good afternoon, and thank you for joining today's webinar on year-end planning strategies. I'm Sammy Azuz, President and CEO of Heritage Financial, and I'm joined by Ed Jastrom, our Chief Planning Officer. Before we begin, I want to share a few logistics. If you have a question, please type it into the Q&A. I'll be monitoring questions during our discussion, and we will address them either during the conversation or more likely just before we close and wrap up. This webinar is being recorded. Once available, we'll share the replay in a follow-up email on our website and on our YouTube channel. And finally, financial planning is very personal, and while some of these strategies apply broadly, not all of these strategies may apply to you, and there are many that we won't be discussing given time constraints. If you have personal questions, please feel free to reach out to us, and we'd be happy to discuss them with you after the webinar. Okay, let's get started. Heritage Financial is a independent wealth management firm based in Massachusetts with 3 offices, clients in 37 states, over 50 employees, and our mission is to make a positive and lasting financial impact on the people in our lives and those we serve. We manage just about $3.6 billion for individual investors and families, and our goal is to deliver personalized wealth management for busy and successful people. Each year, it's important to review your financial situation, but especially given the passage of the One Big Beautiful Bill Act and its sweeping changes, this year in particular, proactive planning and strategizing is essential to saving, growing, keeping, and protecting more of your wealth. Ed is going to share some tried and true reminders, important updates, and thoughtful strategies to consider. All right, Ed, with that preamble, take it away.
All right. Thank you for the introduction, Sammy. Well said. That's kind of exactly what our game plan is. So the title of our webinar is Year-End Moves to Reduce Your Tax Bill and Important Updates. Not eloquent, but shouldn't leave any doubt as to what we're going to cover today. And the way we've set this up for presenting is a few kind of big picture topics related to just, like you said, tried and true, good due diligence for reviewing your financial plan. And then after we cover a few larger topics, we'd like to highlight a few bullet points related more specifically to changes or things that are brand new. So that's how we're going to run. And we did receive a few Q&A ahead of time. If I can work those into the discussion while we're talking, I will. And if not, we'll hit those with any Q&A that come up live towards the end.
Great. Let's get started.
The first big picture topic I wanted to cover, because it's really one of the kind of key points where we focus all year, but has a lot of importance at year end, is retirement planning and retirement plan contributions. So kind of the first reminder, the first year end point we make is check to see if you are on pace to maximize your employer plan retirement contributions. There's likely only a few pay periods left. The year's coming to a close. So if you haven't been able to maximize retirement plan contributions but wanted to, this is also a time to get it on your calendar so that when the year changes, you can start off 2026 on the right foot to do that. One of the big items that is new in this for 2025 and might be for some people in 2026 is this brand new super catch up or mega catch up that people are calling it. And this is highlighted on the yellow line on the screen here. And this just started for this tax year. And a lot of us are already familiar with a catch up for those who are age 50 and older, where once you hit 50 in that year, you're allowed to potentially contribute more to an employer retirement plan. This super catch up added another sub tier of people age 60 to 63 that could potentially put even more in if the plan allows it. So if you didn't do that this year and you're in that age group, or if you're turning 60 next year, this is definitely something to have on your radar. There's a little anomaly there. If you turned 63 this year and could do it, you won't be able to do it next year. You actually go back to what the age 50 catch up is. So it's kind of like a little donut hole there where you might have had one good year of being able to get more in and then back to normal. Not every plan has this feature. It's not a requirement. So it is important that if you're in this age range and you don't know already, or if you're changing jobs to find out what you can do, we have encountered clients that we've suggested they consider doing this and have found out that the plan doesn't permit it. That's also something where if you found out this year that your plan doesn't permit it, it's worth asking again next year because plans do amend their rules from time to time. There's another quirk coming in 2026 with catch-up contributions, but we'll get to that later in some of the updates about rules and regulations that have happened recently.
Great.
Before I jump to the next couple bullet points, one of the common questions that we've received about these tiers of catch-ups is, do I get both? Meaning, do they stack? Can I put in 23,500 and 7,500 and 11,250 if I'm 61
Mhm.
or 62 years old? And the answer is no. They don't add. They don't stack. It's either the regular catch up or the super catch up. You don't add them all together. And just as a point of reference, the figures on the screen are the 2025 tax year statutory limits to retirement plans like 401ks and 403bs. The 2026 limits are usually out by now, this time of year, but the IRS hasn't published them yet, whether that's a direct result of the government shutdown or an indirect result could be the case. But we would expect modest inflation adjustments for these figures to increase slightly for next year. So keep an eye out from us and from other news outlets that'll post that information when the IRS comes out with it for next year's numbers. The other point that we like to make is for individuals who are self-employed, there's several retirement plan options that you might be able to use to get tax deferral, to save on current taxes, to get tax deferred growth, and to just make some forced savings for yourself if you have a savings goal. Things like an individual 401k that really mimics an employer 401k, but is just for you and a spouse, or a SEP IRA are options that we can help establish and determine what one might be able to contribute. Something that I also like to remind some clients of because it's come up, if you participate in an employer 401k plan or 403b, and you have self-employment earnings from some other side gig, consulting, or something else that you do, you still might be able to open your own self-employed retirement plan. The IRS doesn't let you double up on everything, so you can't just open up multiple 401ks and keep putting in 23.5, 23.5, 23.5. But most self-employed retirement plans have a portion that's considered profit sharing or the employer piece. So even if you've maxed out an employer 401k, if you also have self-employment earnings, you still might be able to set up your own plan to set aside more money for retirement savings.
So with those, Ed, are you looking at that before year end or before your tax filing deadline, or into 2026, for the self-employed plans?
Yeah, good question. And I'll kind of hit something with the next bullet point at the same
Okay.
time since it's topical. So the employer plans, all the contributions that you would make from salary deferral, your regular and your catch up have to be done by calendar year end through payroll. For the self-employed plans, you have more flexibility. Generally, we can see that people can contribute to those if they have, for example, like Schedule C earnings, self-employed earnings, up through April 15th. And if they're on extension, you can actually contribute later if you're on extension. So you do have a little more flexibility on the self-employed side. And really, that's because if you're self-employed, heading towards the end of the year into early next year. You might be finalizing your expenses. You might have income that you're waiting for from certain contracts or deals. So the tax authorities know that if you're self-employed, you might not have your books and records finalized by 12/31, and they give you a little extra time to do that. The next point about timelines is in terms of not employer plans, but IRAs and Roths. Those have contribution deadlines for April 15th, and you can't extend those if you go on extension.
Okay.
The reason I put the bullet point there about estimating IRA or Roth IRA eligibility is specifically because you don't have to have those in by calendar year end. You're maybe looking at what you think your income is for the year, maybe determining if you're eligible. But if you're not sure, it's probably safer to wait until you're actually doing your taxes, confirm your eligibility. If you can make a deductible IRA contribution or a Roth, do it before April 15th. If you do it before and then it turns out you're not eligible because of income limits, you can reverse or recharacterize those contributions, but it ends up being a little bit of an administrative headache and it gets in the way of trying to do other things while you're filing your taxes. So even though we don't like having anybody wait approaching a deadline to get something done, the deductible IRA or Roth is maybe one where it's prudent to be certain before you move forward.
Makes sense.
The next idea in terms of IRAs and Roth is one where explicitly someone isn't eligible for a deductible IRA or a Roth contribution. And this is something we've been talking about for a number of years, but we still find opportunities where newer clients or people that haven't started working with us yet maybe haven't heard of this or explored it. And that's the backdoor Roth for high earners. And this is where your income levels keep you out of making those types of contributions, deductible IRA or Roth. But you can make a non-deductible IRA contribution and immediately convert it to a Roth IRA. And if you don't have other IRA money, that conversion can be tax-free. It's a very good strategy. It's been in use for a number of years. It's still missed by people who aren't doing the type of work that we're doing or are who in the know. It's also easy to slightly mess this one up and do something unintended. So anyone who thinks that they could or should be doing backdoor Roth contributions, or if you've heard of it or read about it, it's definitely something that you should do with the guidance of an advisor, like a heritage advisor or a tax advisor, because there's a few moving pieces where you end up with unintended consequences.
Yeah, I mean, this is definitely a big one. I think to your point, a lot of people miss it. They're not doing it, even if they can take the advantage of the backdoor Roth, or they're doing it incorrectly. So, are there resources available on our website to kind of walk people through the backdoor Roth in more detail after this webinar?
Yeah, we've actually got a few fact sheets, and we kind of call them, checklist or cheat sheets
Okay,
on a number of topics related to retirement planning, charitable giving, and some of the other topics that we're talking about.
great.
So those are good resources for kind of one-page take-home tearaways that can walk you through what you're eligible for, what you're not eligible for. And then you're actually giving me a great kind of segue into the next bullet point about health savings accounts. I was going to mention that on our website, heritagefinancial.net, if you go just to the landing page, the homepage, in the top right-hand corner of our website, there's a little icon that kind of looks like a magnifying glass. And anytime we've ever written on our blog about any strategy that we think is relevant, or if we're identifying who the right people are for a certain strategy and whether it might be something for someone to consider, we've got a pretty robust resource of short articles, fact sheets, things that we've written about tax law changes. So anything like health savings account, catch-up contribution, self-employment, any of those keywords that are relevant to our audience right now, using our website and that little magnifying glass to search and see what we've written and produced already on kind of facts and talking points is a good place. And for health savings accounts, there's something that we posted not too long ago, how the health savings account or HSA could really be a medical IRA. or you treat it like that, where if you're enrolled in a high deductible health plan through your employer and you're eligible to contribute to an HSA, their tax benefits are very substantial in that they're often called triple tax free, that you get a tax deduction for money going in, the growth in the account isn't taxed, and if you use it for a qualified expense, the withdrawal isn't taxed either. And one of the kind of unique features of the HSA as a retirement related vehicle, even though it's geared towards health insurance, is you can contribute to it while you're working, build up the balance in the account and invest it for the long term, pay medical expenses that you have presently out of pocket, and then use the growth in the account later after you've retired. And you can even reimburse yourself for expenses that you incur years later. So you could literally have a medical expense today. If you're enrolled in an HSA, you could pay for it out of pocket, allow your contribution in an HSA to grow and be invested for years and years and years. And then when you stop working and you don't have income coming in, you could tap the HSA to reimburse yourself for that expense that you had years before. So there's a lot of flexibility and utility there. I know they're not explicitly a retirement account, but in terms of building a retirement savings and planning opportunities for a more secure retirement, I felt like it really fit in. And there's a good piece that we wrote on our website about how that works. Switching gears for just one bullet point, most of these were related to retirement savers, right? People who are working. The last point is really directed towards people on the other side of that, where if you've stopped working, you're in kind of retirement transition or even later retirement. We want to think about opportunities where if your income is lower for a certain year, for one reason or another, it might make sense to withdraw money, even if you don't need to spend it right away, if you can make that withdrawal at a lower tax rate than you might otherwise be able to do. And that can come in a few different forms, right? That could just be a straight withdrawal from an IRA, or it could be an IRA to Roth conversion. And we're looking at a window typically where, based on your age, maybe you're not collecting Social Security yet, or maybe in a married couple, only one of you is collecting Social Security yet, and maybe you're not taking your required minimum distributions yet from IRAs. So the kind of early 60s to early 70s sometimes present a window where we can do strategic things to kind of leverage your lifelong tax rate. So even though most of this is about saving for retirement, we don't want to lose sight of year-end planning for people who are in retirement and might be able to do something about it more effectively for the long term. Switching gears to charitable giving is one of our other kind of high-level topics. There's a few aspects of this that we'll touch upon during this presentation. It kind of works its way in to a few other related topics. But the most timely one, and I think the biggest one that we've been communicating to clients already, is about something called the AGI floor. And AGI floors as a tax concept have existed before, but this is a new one specific to people who itemize their deductions and give to charity. This is a result of the OBBBA, the new tax law that recently passed. And what's happening is starting in 2026, so next year, if you itemize and you give to charity, you will not be able to deduct every dollar that you give in a way that you typically have in the past. The AGI floor is a 0.5% of your gross income. So the floor is not related to how much you give to charity, it's how much money you make or how much you've earned as gross income. So the larger your income, the more of your charitable gift that you might lose. What that means is that individuals who make very large charitable gifts, even if your income is high, you'll still probably be able to deduct most of the gift. But individuals who make more kind of modest gifts, there's the potential that all or the vast majority of your gift could be eliminated. I'll do a quick example just to make sure that the math kind of makes sense for everybody. So let's say that you're a married couple and your AGI is 200,000. Your gross income on your 2026 tax return is 200,000, and you itemize your deduction. So 10% of your AGI would be 20 grand, and 1% would be 2 grand. So 0.5% would be $1,000. If you normally gave $1,200 to charity, you now have to exceed the 0.5% floor, which is $1,000. So of your $1,200 gift, only $200 would be deductible. So you can see how if your AGI was 250, 300, 400, 500, and your gift to charity was 2 grand, 3 grand, 4 grand, really this could eat up quite a lot of it. Now, what that means, kind of big picture, year to year, losing a $1,000 deduction might not be that substantial. But if this keeps going and going and going, it's $1,000 this year, $2,000 next year, $2,000 next year, it's cumulatively that could add up to a meaningful amount. And there's something you can do about it, which is the bigger takeaway. And that's because it doesn't start until next year. So if you're charitably inclined and you're thinking about making gifts, even if those gifts are relatively modest, you might want to advance some of those gifts into 2025 before December 31st. And one of the best ways to do that, that we've talked about before, is to use a donor advised fund because you can take several years worth of gifts, bunch them together, put it into a donor advised fund, and then drip those gifts out of the donor advised fund over time. And something that we've addressed before, like I said, is exactly how that works. So if you put your gifts together, let's say you give $2,000 to charity a year, starting next year, a big piece of that deduction or all of it is going to go away because of the floor. You could take $2,000 and say, let's front load the next 5 years worth of gifts. Put 10 grand into a donor advised fund this year, itemize your deductions, get a deduction potentially for 10 grand. And then in the donor advised fund, that's a vehicle where you can invest that money and slowly give gifts out to charity. So you don't have to have a single charity to give 10 grand to or $1,000 to. You could do it in small increments and you could do it over the next number of years. So the idea of bunching gifts has been around for a few years now. Bunching gifts, especially to use appreciated securities, where you can gift something that's gone up in value a lot and also avoid the gain, has been around for a number of years. But especially in 2025, because of this floor that's coming next year, it's a even more prescient and timely strategy and something that people who have been giving modest gifts might not have thought about because you wouldn't think about giving 1,000 or 2,000 as a worthwhile amount to strategize, but this year it is. And if you might bunch gifts in that 10 or 15 or $20,000 amount to pre-fund gifts for the next 5 or 10 years, it could make a lot of sense to do this.
How do people figure out, Ed, if they think they're going to be captured by this next year? Is it basically to work on a projection with either their financial planner or their CPA?
Yeah, it probably depends on really how complex your tax strategy is.
Okay.
It really depends a lot on if you know already if you're taking the standard deduction or the itemized deduction. So that's where I would focus is there anything from 2024 to 2025 or 2025 to 2026 about your deductions that might cause you to change your how you file, including your marital status, mortgage interest, property tax, deductible medical expenses. So that's kind of the key point is are you deducting or not? If you are deducting, how much are you planning to give to charity? Don't give to charity just to save on taxes. That logic is kind of a fallacy, right? This is if you were otherwise going to give to charity, we want you to do it in a way that's efficient and productive. But if you save, 24 cents on the dollar giving money to charity, the other piece of that dollar still is gone and not yours. So this isn't letting the like tax tail wag the dog, as they say. But yeah, thinking about what your itemized deductions are is probably the biggest piece to get those ducks in a row, and then talk to an advisor at Heritage or talk to your tax planner to see where this shakes out. Continuing the charitable giving conversation, moving away from donor advised funds and that concept for a minute, there's some other things that should be on the radar, kind of depending on your profile and your situation. And one of the other big strategies separate from a donor advised fund and bunching is for someone who's age 70 and a half or older and has an IRA, you can give some of your IRA directly to a charity, and it magically looks like you never took money out of your IRA and it never shows up in your tax return. It's a great strategy. This is called the QCD, the Qualified Charitable Distribution. And for persons who either aren't itemizing deductions or who have large IRAs, especially if you have IRA required minimum distributions, you can use the QCD to lower your required minimum distribution in terms of what shows up on your tax return. So if you have a very large IRA, you're forced to take money out, that money's taxable. If you had a required minimum distribution of $50,000 and you wanted to give $10,000 to charity directly from your IRA, you could do that, and instead of 50,000 showing up on your tax return, only 40,000 would. There's a major, major point on this that we see almost every year for anyone who's considering using the QCD in 2025, also in 2026 and future years. The not showing up on your tax return is the way it's supposed to happen, but the IRS hasn't been great in catching up to the QCD's existence and providing custodians like Schwab or Fidelity with forms to accurately tell somebody that they used a QCD. So if you do this and you're patting yourself on the back and we're saying, great job, we helped you save on taxes, but your tax preparer doesn't know that you did that, and then they just get a 1099-R that says your distribution was 50 grand, 50 grand is going to show up on your tax return, and then 9 months later, when we're looking at it with you, we're going to look at it and say that you have to go amend your tax return because it didn't work right. So the big, big takeaway for anyone using QCD is to keep your tax preparer informed, because the documentation that you would normally just hand over to someone to do data entry isn't clear. The IRS announced finally this year that they are creating a place on the 1099-R to report the QCD that will help solve this issue. But right now, we don't know if the custodians that manage the tax reporting will be providing that yet, or if it won't roll out until the following year. So the process is in place to fix that persistent ongoing glitch in reporting. But for one more tax year, we have to be extra careful because we don't know yet if that solution will be rolled out for the forms that come out in early 2026 for anybody that does that this year. So something new there that's helpful, but we might just have to keep a really close eye for one more year because we don't know for certain if it'll be reported the way that we all want it to. Uh, Totally different concept from QCD, but potentially targeting the same type of individual who's kind of in retirement and thinking about retirement income. Charitable gift annuities are something that um, we don't discuss kind of nearly as much as the opportunity might present itself for someone who's interested in kind of changing the makeup of their income in retirement. Part of the reason they're not as big a driver as donor advised fund or QCD is because the deduction that you get for them isn't as big dollar for dollar. The reason the deduction isn't as big is because you get something back in return. So charitable gift annuity is where typically very common with higher education institutions or some charitable medical institutions. You take 10 grand, give it to the charity. In exchange for that, they will give you for the rest of your life or some fixed period of time a small monthly income. So the charity gets use of the lump sum and they feed back to you a small annuity. You still get a deduction because you're not getting all of your money back necessarily, and you gave the charity something they can use, but it's not the same as just writing a check for 10 grand to your alma mater and saying, go buy books or go, do that improvement to the sports facility. So it's something that can be attractive if you want to make a bigger gift but need to retain the income because you can't just lose 25 or 30 grand that you otherwise would have making interest for you. Not available for people who are younger. Typically, you can't do it unless you're already into retirement age because the charity doesn't want to have to give back an annuity for a really long period of time. So if you're 45 years old, charitable gift annuity might not be an option. But if it's something where you have a school or some other nonprofit that might offer that, it's worth looking into if you're curious about it. The fundraising individuals who work at all of those places are very happy to share facts and figures about gift annuities, and they often have calculators on their websites that will even tell you what the annuity could be in terms of dollar terms. And one last piece on kind of more advanced charitable giving, not enough in the scope of this presentation to go into, but for those who are looking for more out of charitable giving, not necessarily more for the tax side of things, but that's part of it, but more in terms of their legacy and their values and potentially bringing in other family members. There are more advanced strategies other than just donor advised fund and giving money directly to charities. CRT is a charitable remainder trust, and CLT is a charitable lead trust. They operate in different ways, but they're designed to facilitate generally larger gifts and also to facilitate a little more meaning behind a giving strategy. So I thought I would just mention it in the context of today's webinar so that if charitable giving is something where you're thinking about it or you've been doing it, but you want to do something more concrete, there's more things we could talk about that might not have come to the table yet. And because of that, we thought following the webinar, we have a number of these kind of cheat sheets and guides that I mentioned when Sammy asked me that question, and some especially helpful on the bigger picture charitable giving ideas. So these aren't one size kind of fit all solutions. They're more things to get the kind of mind going and brainstorming and something that you could use to start a family discussion or chat with your advisor, particularly the one that summarizes common charitable giving vehicles. That kind of outlines all the alphabet soup of a lot of these strategies and who should maybe consider them and what they do. So I'll just leave that there as knowing that those follow-up resources are available and something that as time goes on, if you're not ready to look at them now, we have a library of material that we're happy to share along with our kind of one-on-one conversations that we do with advisors. So gifting to family, little different than charitable giving. At least from the tax law, maybe not from your personal perspective. It might seem like charity, but mention it here. There's something that we talk about frequently called the annual exclusion. This is a dollar amount that you can give directly to anybody, to any number of people every year, and any gift to that person up to that amount is basically a free pass go for all intents and purposes, where you do not have to file a gift tax return if it's below that dollar amount. It's 19,000 for 2025. So if you're thinking about gifting to a family member, a child, a grandchild, someone who's in need, that is the amount that you can do without having to file a gift tax return. However, a lot of people are fixated on the concept that you can't gift more than the 19,000. That's not the case. All that figure means is above that amount, you have to file a gift tax return. The gift tax return for the vast majority of people is informational. You don't actually owe any gift tax in dollars. You only start to come into the threshold of owing tax on those gifts if you've used up your lifetime exemption for your estate and gifts, which is 15 million next year and just under 14 million in 2025 per person. So if your estate isn't currently at those levels or won't be, and you want to give more than 19,000, and it's fundamentally important for you to do so because it would help someone get out of debt, or it would help someone with a business opportunity or something like that. The 19,000 shouldn't be a hard line of stopping. It just means you need a slightly more advanced dialogue with your tax preparer and your heritage advisor to determine, yes, it does make sense to do this. So don't think that the 19,000 is a absolute freeze. Sometimes people misunderstand what that means. In addition to 19,000 though, you also do get another couple kind of freebies where it neither uses that annual exclusion that you can give, nor does it do anything to affect your lifetime estate and gift exemption. And there's two big areas where those are ones that you don't want to miss the opportunity if you're going to do it otherwise. So I can pay and you can pay tuition payments directly to a school for anybody that we want. And if you do it directly to the school, it doesn't count towards the 19,000 to the ultimate beneficiary. And same things for healthcare expenses paid directly to the provider. So required healthcare for someone you can pay and it doesn't count to the 19,000. So those are two things where you could help someone with tuition and healthcare and give them the 19,000 and be in the clear of not having to file like a gift tax. So it's kind of that whole umbrella. The one common standout amongst clientele and people that we talk to is if you're contributing to a 529 savings plan that will be used for tuition for someone, that counts as the gift. So you can put in up to 19,000 per person, but if you go over that, that has to be something that you report. So that's where one, if you want administrative ease, don't go over the 19,000. 529 plans have one quirk where you can do something called super funding, and you can do 19,000 times five all at once and basically precede, the vast majority of a college education and just kind of check the box. That does require a little extra disclosure. It doesn't actually use your lifetime gift or estate tax exemption, but you do have to report that you're kind of doing that and you use up the 19,000 that you would otherwise have. This time of year, if anyone's thinking about super funding a 529 plan and putting more than 19,000 in, the strategy to consider would probably be do the 19,000 in 2025 if you haven't already, wait to do the super funding until 2026. You basically get an extra year of annual exclusions because you can do this year and the 5-year gifting in 2026. If you did the 5-year gifting super funding right now, you're eating into your annual exclusions for the next 5 years. So if someone's has that in mind, really wants to, set up a child, grandchild, or somebody else that you know for college funding, don't do the super funding right now. Do a super funding by waiting until January and getting the 19,000 in now.
Makes a lot of sense. Some time check, Ed. We have about 10 or 15 minutes plus Q&A. So just want to make sure that we're on the same page there.
Thank you, Sammy. I will wrap up with our last couple topics. Roth conversions is one that we hit quite often, and the first question on that is why. There's any number of reasons. Part of it's leveraging tax rates. If you might be in a lower rate today than you might be in the future. Part of it could just be more flexibility. If you don't have a lot of Roth money now and you have a lot of IRA money, doing some conversions might give you more choice in the future. It also might help protect a surviving spouse. There's something that we sometimes call this spousal penalty or a widow's penalty where the survivor might be in a higher bracket. So a few different reasons. The main one that I've bullet pointed here separately that we were thinking about more is legacy. And that's because non-spouse heirs generally have to deplete an inherited IRA in 10 years. So that can mean that if you have a very large IRA and you leave it to your children, your adult children might have a lot of money coming out in a very short period of time at very high tax rates. So a few different reasons, but the ways we think about it is using those low income years, try to spread out your tax liability, think about conversions within a bracket. So that's just looking at, I'm in the 22% bracket. I've got 20 grand before I hit the 24%. Maybe we convert, up to the top of the 22 and kind of eat up that bracket. And then the charitable giving strategies we talked about, pairing conversions with charitable giving can be something where, we're really getting a lot of value if we're crossing off multiple goals at the same time. So whenever we talk about any of these strategies, if we can combine them, it's best not to look at them in total isolation, which is one of the other reasons that if you have other advisors talking about single items, a tax advisor and estate planner, it's really great to loop in your heritage advisor because we might have other kind of side strategies to bring into the conversation. Something that is a word of caution, the latest tax laws have created a few more unintended consequences for doing Roth conversions, where the conversion itself can create more taxable income that you weren't expecting. Some of these have been around before, where the conversion dollars can make more of your capital gains taxable, more of your Social Security taxable. But there's a few others now that we really have to watch out. So Roth conversions remain viable, but we have to be more careful in our consideration than we were before. And a reminder, there's no do-overs. So you can't undo the conversion if you end up with the unintended consequences. So switching over now to more just kind of one-off quick topics that didn't fit into the rest of this, and then we can see if we can hit some Q&A. Mostly related to the OBBBA, but some other things that come into play. Trump accounts, a new savings vehicle for minors. Too soon to know if it's a viable tactic to complement other savings, but there's a pilot program. If you have a child born in 2025 or in the near future, you get $1,000 free from the government. So even if Trump accounts don't end up being a good tool, it would be foolish not to get your free $1,000. They don't exist yet, really. So this is an early 2026 thing to have on your radar. Luckily, we have a few colleagues here at Heritage who, between them and their spouses, meet this criteria. So we should be able to relay some things firsthand about what they had to do to get their $1,000 when that happens. Jumping back to 529 plans, It used to be that you could use $10,000 from a 529 plan for K through 12 per year per child. That has doubled to 20,000. The things you can use it for K through 12 are also greater. And for expenses other than what we traditionally think of for like kids in college or K through 12, 529 plans can now be used for some professional education and ongoing continuing education. So people who are in the trades or have ongoing certifications might want to explore that too. For people who have children that you take care of, and you might be paying a nanny or a daycare or childcare. There's a big jump in what you can put into a FSA or a dependent care flexible spending account. This year, the contribution that you could put in and get a tax deduction was 5,000. Next year, it goes up to 7,500. So a big potential increase. If you're in the even a modest tax bracket, you could easily save $600 on something you were spending money on already. You probably need to make that election now if you're going through open enrollment, if you didn't already spot it, but keep that on the radar for 2026 if you weren't able to do it for an election in 2027. Business owners might be able to get what's known as 100% depreciation for certain purchases. This just means that you could accelerate the tax benefits for things like machinery and equipment. The warning here is just because you can get that accelerated tax benefit, don't necessarily go out and spend a ton of money on things you wouldn't otherwise get anyway. It still costs money to buy it. It still costs money to maintain it. You still might have insurance, but don't let that window be lost if there is something you might spend money on that could increase your productivity or your output. That's a good one to really have an in-depth dialogue with your tax planner on.
Is that for this year or next year, Ed, or both?
For both.
For both. Okay.
So it's retroactive back to 2025 purchases
Okay.
made not all the way to Jan 1. The date, I'm missing it right now. I feel like it's January 15th or something like
Okay.
that. But so purchases made in 2025 already or upcoming, something to keep an eye on, if especially if you were going to do something anyway, or if you were increasing your production or thinking about expanding your business, it's another incentive that might make that more feasible in the near term. This jumps back to the catch up, the super catch up. So my first bullet point here, are you age 50 or older in 2026 and made greater than 145,000 in 2025? If you meet those criteria, you might have to use the Roth portion for your employer plan for the catch-up portion. So 50 or older next year, make more than 145, either the regular catch-up or the age 60 to 63 catch-up. You might not be able to deduct it starting in 2026. You can still make it, but it's going to be the Roth version. So all else being equal, you can still get money into a retirement plan, you can still get tax beneficial growth, but you might have a lower deduction because it has to go in as Roth. I would expect a lot of people to start receiving communication about this from their employers and from their retirement plan providers as year-end disclosures start to come out if you haven't already. There's a new senior deduction for people age 65 and older. That is from the OBBBA. The main takeaway from that is things like Roth conversions or realizing capital gains can make you ineligible for that. So that's one of those unintended consequences of the conversion that we have to watch out for that wasn't new. It's a new deduction. This is the Social Security not taxable kind of missed publication back when that was coming out. So it isn't actually tied to Social Security. It's just for seniors. It should be helpful for a lot of people, but something that income will cause to be phased out. The next big one that will affect a lot of people is the SALT cap is going from 10,000 to 40,000 starting in 2025, starting this tax year. The SALT cap is what you can deduct if you itemize for state income taxes and local property taxes, so your real estate taxes. So if your property taxes alone were 12,000 or 15,000 last year, doesn't matter. The cap was 10 grand. You couldn't deduct more than that. Going forward for the next several years, the cap is 40,000. So you might be able to get all of that and then some, but this does get phased down when your gross income crosses 500,000. If you get to 600,000, it goes all the way back down to 10. So good news, you might be able to deduct more. Bad news, there's a phase out, but it won't be worse than what it was before. You still get at least the 10 grand. And good kind of point to end on here before we hit a few other real quick year-end reminders is the estate tax exemption, as I mentioned, is being fixed at $15 million starting next year, increasing for inflation. The big concern that was happening before OBBBA was would that get cut in half and go down to 7 million? That doubt is now gone. So a good opportunity for very high net worth individuals to consider some more permanence in their estate planning, consider more gifting without the uncertainty of that law, but definitely be aware of state estate taxes, which do not typically have nearly as high exemptions. Massachusetts is 2 million per person and doesn't have portability. Before we get to Q&A, these aren't exactly tax related, but good year-end reminders. Pull your credit reports from the free online resource, annualcreditreport.com, if you haven't already. Check your driver's license, your passport, any medical IDs for expiration so you don't get caught, especially in turbulent times. We want to make sure those things are all up to date. See if you have any lost property. In Massachusetts, the Find Mass Money is a real usable tool. Dollar amounts are typically pretty small, but it's free money and you can file most claims online, so take a look. And if you have minor children who are turning 18, if they turned 18 this year or next year, think about talking to your advisor and your estate planner. Do you need some basic documents, power of attorney, healthcare proxy? Those are issues where you want to be well prepared for the unforeseen and not get caught with any surprises. So wrap up, very high level, things we talked about, helping your family, giving to charity, looking at your retirement savings, tax planning opportunities, topics that you want to talk about with your advisors. I'll flash this real quickly. Don't expect people to be able to see every detail of it on the webinar, but really big picture, we're doing a lot behind the scenes to think about all of these topics from tax planning to your estate plan to claiming Social Security. And we'll try to bring as many of these things to our clients proactively as we can in person and with tools like this webinar and our blog posts. But if you as a client or as a prospect have things on your checklist, we love to talk about these topics. It's what we enjoy doing. It's why we're here. So don't be afraid to email us and call us and put these things on the agenda for your benefit. I'll stop there, see if we can get a couple of minutes of Q&A in. There's a couple things people sent in ahead of time, but Sammy, what do you have on the docket for the Q&A?
Yeah, great overview, Ed. Thanks for sharing all of that. It was definitely something to give people to think about and act on over the next 6 to 7 weeks. The first one is a logistical one. Are we going to be sharing copies of these slides? So this webinar is being recorded. Once it's available, we'll share the replay in a follow-up email with everybody who registered. It'll be on our website and on our YouTube channel. And obviously, if you have specific questions, please don't hesitate to reach out. So that's the first one. How about one of the ones that came in kind of prior to kicking off, Ed?
Yeah, one of the ones that came in that fits into our dialogue was, um, is it worth paying taxes now in converting IRA to Roth? How should I consider my age? Fits right into what we're talking about. Is it worth paying taxes on a Roth conversion? Um, we can never say for certain, right? Because we don't know what the future brings. But we can use our financial planning tools to really make a good assessment about cases for conversion where it seems very strong indicators look like a conversion could be very beneficial. cases where it really doesn't seem like it makes a lot of sense, and then a little bit of the in between where we have some criteria subjectively to weigh pros and cons. Where I would kind of fall back on that is what are you trying to accomplish and how many goals can we cross off simultaneously? If you have one goal and it's to leverage my own tax rates, a Roth conversion could make sense to do that. But if you also want to consider how inheriting a Roth IRA might be better for your heirs than a regular IRA, if you also want to add more Roth money, if you also want to protect a surviving spouse, the more potential goals that we can cross off, the better, because the probability of the conversion having a good outcome because it checks off two or three or four of those goals leans into it. So I think start the conversation with goals, figure out what cross section of things you're trying to accomplish, and then let us kind of do the projections to see what it looks like. But my first kind of gut reaction is the more things that you might be able to do with the conversion in the long term, the more likely it is we'd lean into it because the more goals we can check off, the better for each person.
And just another logistics. I see somebody with their hand raised. I can't do anything with that, but if you want to type in your question into the Q&A box, we'll answer them. So I have a question here, Ed, and I think we need more information, but if not, take a stab. Otherwise, we'd encourage the questioner to follow up. On the SALT cap deduction, does that include interest paid or just tax paid?
The SALT cap does not include interest paid the way I'm thinking of it.
Okay.
So if one were to look at a Schedule A, which is where you itemize deductions, the SALT cap section is kind of one block just under the top, and that's where you would put in the taxes that you paid to the state that you live in, or sales tax to the state that you paid sales tax if you live in a state without an income tax, and your property taxes and personal property taxes. For the vast majority of people, those two items that are subject to the SALT cap are income taxes paid to the state and your property tax. Entirely separate section, mortgage interest for deductible mortgage expense, interest income expense for investment income that might be deductible, medical expenses, separate section, charitable giving, separate section. So I think the way the question was posed is no, the SALT cap does not include interest that you paid. But if that wasn't what that questioner was getting at, you know where to reach us and happy to chime in with more details.
Yeah, and as we're winding down, if anybody has any questions that they think about afterwards that we weren't able to address, please don't hesitate to reach out. Again, you'll receive information on how to do so after the webinar. So thanks, Ed, again for doing this. At Heritage, we offer a variety of ways to help you stay in the know. Our weekly blog and bi-weekly podcasts are two ways in which we share timely information on market events, planning strategies, legislative changes that might impact your financial plan, among other topics. Not all of the strategies mentioned today are going to work here for everyone. The best way to understand where you should be focusing your efforts to maximize your wealth before year end is to look at each of the strategies that Ed talked about in the context of your full financial picture and set priorities. And as we wrap up, I would like to invite anyone that has an interest in talking about these planning opportunities and strategies or about your personal situation to reach out to us directly. If you're a client already, just touch base with your wealth management team. If you don't work with us, our contact information is on the screen and will be in the follow-up email. We would be happy to learn more about your overall financial goals and share a bit about how we work with serious investors. Lastly, as soon as we close the webinar, you'll see a survey pop up on your screen. It's very brief. We would greatly appreciate your feedback on today's presentation, as well as any suggestions you may have about future events that we can bring to you. Thank you again for joining us today. Have a great rest of the afternoon.